Welcome back. India's CPI and the US consumer price inflation for March have both come much lower than the February levels. But then the separate news item for macroeconomists is that the FOMC minutes clearly show that there is an expectation of recession, albeit mild, but a recession. So where does all this leave the rates story, but more importantly, the India growth story? I have with me Shantanu Sengupta, the Chief India Economist at Goldman Sachs. Shantanu, good morning and thank you very much indeed for joining us. Well, first up, I think the easy question, the inflation numbers coming in much lower in India. So clearly now, no two thoughts. The Reserve Bank may have said it's a pause and not a pivot, but rates have peaked, you would say?
Yeah, thanks, Lata. That's absolutely right. We think that rates in India, policy rates in India have peaked. We think that CPI inflation will remain below 6%, which is the upper end of the target band for the rest of the year, and the RBI therefore remains on hold, in our view, till the end of 2023. I think the encouraging news from yesterday's print was that core inflation came down, especially core goods, which we were anticipating to come down, maybe a month down the line. That fell from our estimate of 7.3% to 7%. Core services also came in slightly lower, despite housing going up a shade. So I think from core inflation point of view, RBI will take this data very positively, and we therefore expect to hold till the end of the year.
But let me persist on two counts. The Reserve Bank governor's quotes, the decision to pause is only for this meeting. Do you remember those words? As well, they are a distance from 4%. Even if you take the Monetary Policy Report, the MPR forecast, they're only at 4.4 in FY25. This MPC has the distinction of not seeing 4 at all. Don't you think at some point in time they may want to get there, and therefore, is there a hike somewhere?
Look, I think if you've paused from a 4-2 hike in the previous meeting to a 6-0 in favor of pause now, then the bar for you to hike in the future, unless you have a reflationary circumstances, is very, very low, right? So, I mean, that bar has gone just higher. So you need to see probably commodities going higher, oil going higher, more pressure on core inflation, the global macro turning around, US probably reflating further, and therefore the Fed pricing in more hikes. I mean, the market's pricing in more hikes from the Fed. All of those events have to come together for this MPC now to shift towards
Fair
a
point.
hike, I would
Fair point. Now, let me just flip the question. The markets, if you looked at the futures rates, or rather the OIS rates, they seem to be penciling in a cut later this year itself. Now, considering that your mandate is 4%, is this pricing it too soon? Should we even price cuts next year like you are?
So that is one of the reasons why we have pushed the rate cutting cycle out. So our view earlier was that the RBI goes to 675 in the April meeting, and therefore we had a cut penciled in for December meeting. Now we have pushed that out. We think that they remain on hold at 650 for the rest of the year, and then we are penciling in something next year, which is in the first half of the calendar year, only 50 basis points. So our view is that exactly partly because of the reasons that you said, that core inflation has remained fairly sticky and you haven't seen 4% yet, you are likely to see a shallow rate cutting cycle this time around. So because your peak rate is only going to 650, you'll probably see about 50 basis points of rate easing next year, if the global cycle turns around as well.
Okay. I mean, they would still be culpable in the sense the 4% is not in sight, but we never know what their forecast will be a year down the line. Let me come to growth now. The reading from the FOMC minutes are not looking good for growth. The TCS numbers, the first bellwether that's given the numbers, are also indicating that North America is a problem. And therefore, there will be a spillover effect on growth. Will RBI have to change its growth numbers?
So from the global perspective, our 12-month recession probability remains at 35%. Now, this is above 25, which we had earlier prior to the SVB weekend. But the 35 is still significantly below the 65% that Bloomberg consensus is building in, as well as some of the views of the Fed staff. So we think that globally the risk of an outright banking crisis has declined. There's no additional institution which has failed since the SVB. Fed lending to banks have come off the highs. Deposit flight has also subsided. So if you don't have a deep recession, we would think that the headwind is slightly lesser, yet there will be some headwind to your export growth numbers. However, there's one other thing which is going on in India, which is the services exports is surprising on the upside. It's taken, I think, all analysts, including us, by surprise. And this we are seeing is services software export delinking from the top 5 IT companies. So earlier there was a very tight correlation between top 5 IT companies' dollar revenue growth and the services software export growth that you were seeing in India. Whereas over the last 5 quarters or so, the growth rate for the top 5 IT companies' dollar revenues have declined, whereas India's software export growth has remained in the region of about 20 to 25% year over year. So that is a very positive development. It means that our services exports are getting more and more broad-based. It's not just linked to a few companies, and that is sort of offsetting some of the net export drag that you would have seen from global conditions slowing down.
Okay. Yeah, I have written print and video on this to my heart's content, Shantanu. In fact, it's not just that the software growth is, I think, about 18% for the first 3 quarters, much better than the software companies. The non-software growth is like 37%. So services has clearly exploded. But how much will that mean in terms of GDP growth? Is your number close to the Reserve Bank's?
So we are lower than the Reserve Bank. We think 6% growth for calendar 23 is what we are baking in. Some of the downside risks obviously come from the global conditions. But again, within India also, services, if you look at PMIs, they have held up fairly okay till now. And therefore, with the government's focus continuing to be on capital expenditure, and a relatively lower net export drag than what we were anticipating earlier. And you're absolutely right about business services also, which could be a result of GCCs or the consulting firms doing more in terms of their businesses. All this just provides a little bit of offset to the global economic conditions slowing down.
Mm-hmm. Okay. Any worries at all because of the consumption slowing? Even see yesterday's IIP number. What was doing well? Infrastructure and capital goods. What did badly? Consumer durables and even non-durables, although it was a positive number, was coming off a really poor base. So are there worries that even domestically consumption may not hold up and therefore growth may not be even as good as 6?
So that's exactly right. That the IIP story is not just last month. We have been seeing this for the last many months now, that consumer durables, we look at this from the pre-COVID base seasonally adjusted. The consumer durables production side has been lower than pre-COVID averages, whereas the infrastructure and construction goods, again, partly held by the government's focus on capital expenditure, has been in expansion for the last 20 months or so, versus pre-COVID. And that's really the kind of growth that you're seeing in the economy. The consumption probably will slow down a little. That's what we are baking into our estimates as well. We think that investment growth, particularly led by construction, remains fairly okay. And again, as I'm saying, the net export drag, which I was anticipating earlier, is lower now because, of what you're seeing on services export. I think, current account estimates are now coming in the handle of, early 2%, sometimes, lesser than 2%, versus about 3% what market was baking in earlier. That causes a large swing also in terms of growth numbers as well as stability on the FX front, apart from the fact, of course, that the dollar has remained fairly benign.
You've snatched my next question. I was coming exactly to that. For the probably the first time or maybe after a very long time, we are extremely confident on the external front. In fact, the quarter that just ended, we are actually current account surplus. Now, it may come into perhaps a minor deficit. I doubt it will be even 2 in the current year. It's going to be way off 2%. And it's also coming at a time when the Indian inflation is not much higher than the global inflation or than the US inflation. What does all this mean to the currency? Are we going to see appreciation?
So we are still penciling in. I mean, on the appreciation front, we are still penciling in a slight bit of BOP deficit for the year, given wherever your current account estimates are. Just given the fact that the flow situation until Fed funds rate remain in this 5% region may not be as conducive for EMs. Typically, you find that in balance of payment deficit years, on average, the INR depreciates. However, this, I completely agree, this is a completely different dollar cycle. Our view is that if you end up getting excess flows, the RBI will mop up reserves because and not let the INR appreciate, because they have already figured out through the course of 2022 what the high level of reserves meant in terms of sort of going through those or navigating through those macro shocks.
Sheer confidence
one
to the
after
market.
another. Yeah, exactly. And then, with the dollar now in a decline, you're also having some revaluation effects on the positive side this time, right? So you're getting close to $600 billion of reserves. So that's why we think that it's going to be capped on the left-hand side. And our view is that the INR remains in the 83, 82 kind of band over the next 6 months or so.
Okay. And yields, you think 7.2 is about it? Or do you think we could see higher yields as government borrowing picks up?
We don't put out an official forecast on 10-year bond yields. Our view, as I said, is that 650 is where the RBI caps the policy rate, and therefore difficult to see probably much higher 10-year yields as well. There will be some supply effect clearly on the bond curve, but we would think that around this level is where it will cap off.
Oh, right. Okay, I will have to leave it at that. But you've given us a very clear idea of all the contours that make up the macroeconomic setup, external accounts, current account, inflation and growth. So it does look like growth will be under pressure, but the positive will be that inflation is not going above 6 at all. Perhaps we're going to see a couple of 4-point-something readings. We'll wrap up on Bazaar on that note. Chartbusters is ready for you.
Brought to you by Union Bank of India.